Welcome to the Pro Ticker Deep Dive. Today we're tackling one of the biggest, and I think one of the most subtle systemic risks hiding in plain sight in modern finance, and that's the massive boom in passive investing. For over a decade now, the mantra has been, set it and forget it. It's cheap, it's efficient, and yet it has reliably beaten most of the high-cost active strategies. But if you follow financial markets, you have to be asking this critical question. If the overwhelming majority of capital is now, buying mechanically, just allocating based on an index's weight, who is actually left to do the fundamental work of setting the right price? And more importantly, what happens when the music stops? When we face real market turbulence, does this passive system absorb the shock, or does it actually become an amplifier?
That core tension, that question, is the focus of our entire deep dive today. We're effectively running a structural stress test on the passive era. We're pulling from really comprehensive data through late 2025, looking at investment flows, ownership concentration, market structure, and some of the technical trading dynamics. Our mission is to move beyond the whole fee debate and determine, as best we can, if the rise of passive has made modern markets safer or dangerously fragile.
The scale of this is just staggering, and it really defines the whole environment we're analyzing. Can you walk us through those numbers?
Yeah, the executive summary is pretty clear. Passive has fundamentally reshaped asset management. It's decisively won the flows war. As of late 2025, passively managed U.S. mutual funds and ETFs now control over $19 trillion in assets.
19.
19 trillion. And that compares to roughly 16 trillion in active strategies. So for the first time, mechanical indexing is the dominant force. And for you, the listener, what that means is the default choice for pensions, institutions, retail savers. It's now structurally mandated to buy the market regardless of price.
That really puts the stakes in perspective. Okay, so before we get to the stress points, let's do a quick rewind. How did we get to $19 trillion? We have to understand the environment that, nurtured this whole thing.
The passive era was perfectly incubated by the 2010s. I mean, think about the defining factors of that decade. You had near zero interest rates, aggressive, sustained quantitative easing by central banks, and just a severe lack of viable alternatives.
Right, the TNA era. There is no alternative.
Exactly, TNA. There was really no alternative to equities if you wanted any meaningful return on your money.
So if bonds are paying basically nothing, and the central banks are guaranteeing a slow and stable environment, why would you pay an active manager high fees just to own the index anyway?
Precisely. And the academic studies confirm this over and over again. After you factor in those often hefty fees, the vast majority of active managers just failed to outperform their benchmark over long periods. The whole value proposition for active stock picking just kind of evaporated. The market rewarded not complexity, but simplicity and low cost. So low-cost index tracking products became the powerful, logical default.
And what's particularly telling in the source material we've looked at is the inertia of this trend. We know the macro environment fundamentally shifted in 2024 and 2025. Policy rates spiked, central banks started shrinking their balance sheets, the cost of capital completely reset, and yet the passive flood just continued. Why didn't that high-rate environment give active managers a chance to, prove their stock-picking prowess?
It's a powerful illustration of habit and institutional inertia. Despite that dramatic regime shift, the money kept accelerating into passive. Over the 12 months leading up to June 2025, passive funds pulled in an estimated $899 billion in net inflows.
Almost $1 trillion.
Nearly $1 trillion, all while rates were high. And at the same time, active strategies, especially U.S. equity funds, saw these huge net outflows, about $230 billion. Investors were just fleeing those high-cost vehicles.
And this wasn't just, mom and pop investors updating their 401ks. This is highly institutionalized, which is crucial for the market structure.
Oh, absolutely. The largest pools of capital, we're talking massive pension funds, sovereign wealth funds, university endowments, they all increasingly rely on large cap equity and core fixed income ETFs as just, strategic building blocks.
So they're embedded in the plumbing.
Deep in the plumbing. When an endowment decides to allocate, say, 40% to U.S. equities, they often just plug in a broad index ETF. So passive ownership is now a structural feature, not just a retail preference.
Okay, so let's unpack this. If passive ownership is now structural, that's where the complication and the risk really starts to build. When you look at systemic fragility, you have to start with ownership concentration.
That's where the research gives us the clearest warning. We see this extreme concentration risk posed by a handful of giant index fund groups. People often call them the Big Three. Collectively, these firms often hold between 15 and 25% of the outstanding shares in many, many S&P 500 companies.
Wait, hold on. 15 to 25%. If three firms own that much voting power, are we just trading market risk for a new kind of governance risk? I mean, isn't that power a huge structural issue on its own, separate from volatility?
That's a really important question, and it gets to a key finding of this stress test. Index funds are, in a sense, illiquid. They aren't easily traded based on short-term views or valuation. Their mandate is just to hold indefinitely. So when three firms hold these massive, permanent, and largely inflexible stakes, it raises all sorts of questions about homogenized views on things like ESG, corporate strategy, executive pay, all across hundreds of different companies. It's a huge concentration of stewardship power.
So if the market isn't reacting to valuation, it's just reacting to these mechanical flows.
Yeah.
Walk us through the mega firm dynamics this creates.
So when passive money flows in, the mechanism is automatic. It buys all the stocks in the index proportional to their market capitalization. Since the S&P 500 is cap-weighted, the largest companies, the mega caps, they get the vast majority of the absolute dollar inflows.
Right.
So imagine two stocks, one's a $10 billion company, the other's a $1 trillion company. The $1 trillion stock gets 100 times more money from that index fund inflow simply because it's bigger.
And this causes what the sources call idiosyncratic volatility for the biggest names. It feels like the price action becomes detached from the actual business fundamentals.
Exactly. Idiosyncratic volatility just means volatility specific to that company. And so the prices and that specific volatility for the mega caps are lifted disproportionately, often way beyond what a pure fundamental analysis would suggest. That automatic bid is just relentless.
It just drives up their valuations.
Drives them up and skews the entire market size distribution towards the largest incumbents. And for the smaller firms, they miss out on that free mechanical capital infusion.
So capital gets more expensive for them.
Precisely. Smaller off-index firms find capital more expensive, more volatile, and that's a structural headwind for competition, for innovation. The financing conditions are just heavily biased toward the companies that are already huge.
This all brings us to the core financial concept that underpins this whole systemic risk.
Yeah.
The inelasticity of demand. How do we define that for our listener?
Well, think of it this way. Traditional active investing is elastic. If a stock's price rises 10%, an active manager looks at it, decides, that's too expensive, and they stop buying or maybe even sell. They're price sensitive.
Okay.
But passive flows are essentially price insensitive. They're inelastic. If the index rules say buy 5% of Apple, the index fund buys 5% of Apple. Whether the stock is at $100 or $300, it's mandated exposure, not valuation-based exposure.
So you have this massive growing part of the market that is just buying regardless of price, simply following a set of rules.
And that's the vulnerability. The entire burden of price discovery, all that necessary complex work of analyzing cash flows and risk and valuation, it falls onto a shrinking pool of active arbitrageurs and professional traders. In calm times, it works fine. But if that smooth inflow reverses and a large chunk of capital needs to exit, there may not be enough active capital there to absorb the selling without violent price gaps. And if we connect this to the bigger picture, we get to the stress test itself. The key question is this: what happens when that smooth, inelastic inflow reverses? Does the passive machine amplify volatility in a panic?
We first have to nuance the types of passive vehicles, though. Not all passive money behaves the same way under pressure, right?
That's right. Historical analysis suggests that passive mutual fund flows have actually been pretty stable during mild stress. They often show less pronounced outflows than active funds. But exchange-traded funds, ETFs, are a completely different animal.
Because they trade like stocks.
Because they trade like stocks, they can be significantly more flow volatile, especially during a sharp market turn.
And this volatility can create these really dangerous feedback loops, especially when momentum breaks. Walk us through how that return-chasing dynamic works in reverse.
It's a mechanical chain reaction. When inflows are strong, they push prices up. Those strong past returns attract more flows, and the index fund's own performance becomes its best marketing tool. It can inflate bubbles, especially in, niche or less liquid areas.
But when sentiment turns,
When sentiment turns and that momentum breaks, the same mechanical, rules-based structure works brutally in reverse. Outflows force selling, which pushes prices lower, which triggers more outflows, and you get this self-reinforcing mechanical spiral downward.
and a major pressure point here is the liquidity mismatch, which I know is particularly bad in less liquid asset classes like, say, corporate credit or small caps. ETFs promise intraday liquidity to the investor, but that liquidity can be conditional.
It's the illusion of liquidity. When you buy an ETF that holds, say, thinly traded corporate bonds, you assume you can sell your ETF shares instantly. In calm markets, this works because of the authorized participants, or APs.
Okay, let's pause there and make sure we define that clearly. Who are the APs and what's their role?
The APs are massive financial institutions, usually big banks or trading desks. They are the crucial link between the exchange and the fund. They're the only ones who can create or redeem new ETF shares directly with the fund itself. So in normal times, if the ETF price on the exchange starts to dip below the actual value of its assets, the net asset value, or NAV, the AP quickly buys the cheap ETF shares and redeems them for the more valuable underlying assets and pockets the difference. That keeps the ETF price tightly tracked to the NAV.
But under stress, that critical arbitrage channel just gets gummed up. The APs can't reliably do their job.
Exactly. If the underlying assets, let's say those thinly traded high-yield bonds, suddenly become difficult or impossible to sell, the APs can't afford the risk of redeeming the shares. The arbitrage channel breaks down, and that leads to these sharp discounts to NAV. The ETF price trades below the value of its holdings, which stresses not only the APs but also the investors who suddenly realize the liquidity they thought they had was just an artifact of a calm market, not a guarantee.
Finally, we need to analyze how this passive footprint fundamentally shapes daily trading dynamics, the actual tape. In an uptrend, we know the steady inflow acts as a consistent incremental bid.
Oh, it absolutely smooths things out. It reduces the frequency and depth of normal pullbacks. It's a structural dampener on upside volatility.
But on the downside, the structure changes completely. It leads to what our sources call air pockets.
Yeah, that's a great term for it. When broad risk aversion hits and equity ETF selling picks up fast, it forces those crucial authorized participants to deliver the underlying shares into the market. Because the market has already lost depth, this selling often results in these sharp moves, these huge gaps through prior support levels, and high trading volume that actually hides very poor order book depth.
So it looks like a strong market, but there's no one there to buy.
There's nobody standing ready to absorb that volume.
And I think the most crucial technical insight here connects the behavioral and the mechanical, the role of key technical levels. Widely watched indicators like the 200-day moving average on the S&P 500, they can become what you'd call reflexive lines in the sand.
That phrase perfectly captures the risk. They become reflexive because a decisive break below a line like the 200-day doesn't just signal danger, it actively triggers danger. That one event can signal systematic strategies like risk parity or volatility targeting to deleverage all at the same time.
So it's a chain reaction.
A huge chain reaction. You combine that systematic selling with the mechanical passive outflows, and you accelerate drawdowns far beyond what the day's fundamental news alone would dictate. The system, in a way, starts to eat itself.
So to bring it full circle, what does this all mean? Does passive investing pass the structural stress tests we've run today?
You know, from the perspective of the individual long horizon saver, the person who religiously dollar cost averages into a broad, low-cost index fund and is disciplined enough to avoid forced selling, the answer remains, for the most part, yes. The fee edge is undeniable. Index funds are still a powerful default strategy for wealth accumulation.
But you've shown that at the system level, the story is completely different. The market's wiring has changed. It now has these inherent fragilities: extreme ownership concentration, inelastic demand, and conditional liquidity that just breaks down precisely when you need it most. So passive should be viewed as a powerful tool for diversification, not as risk-free market infrastructure or some kind of guaranteed safety net.
Exactly. The index era isn't over, but the strategy has to evolve beyond just buy the market and forget it. The real edge now, I think, lies in combining that passive efficiency, the low cost, the broad access, with targeted active decisions. This means being active about managing liquidity risk, understanding factor tilts, position sizing. For investors today, understanding the structural mechanics of the market is just as vital as reading a corporate earnings report. And this leaves us with the final provocative thought we touched on earlier, something for you to mull over. Because ownership is so concentrated, a few giant index managers now hold immense stewardship power. They control massive collective votes on ESG, on strategy, on executive pay for most of corporate America. And while this concentration can push for better governance in some areas, it also carries the risk of, well, homogenization of corporate views across the entire S&P 500. So the question is, how comfortable are you outsourcing corporate governance to a handful of index giants whose primary and sometimes conflicting mandate is simply to track the market?
See you all in the next ProTickers Deep Dive.